Well, Mr. Maverick, Shankar Sharma himself joins me. Shankar, fantastic to have you back and thank you for joining us. Well, the backdrop has been quite noisy. China, Greece, crack in commodities. But despite a noisy backdrop, Indian markets have been quite resilient. Isn't that remarkable?
Yeah, that's because, while quite a few Indians can find China on the map of the world, but I don't think more than 1% of the country can find Greece on the map of the world. So, Greece, in my view, was a non-issue as far as India was concerned. I thought it was a reasonably serious issue for the countries around Greece, which is basically the Eurozone. But also at the back of my mind, I was fairly certain that some deal would be struck, and that's really what has happened because, they cannot let a first world country go down. And there are a lot of posturing, etc., etc. But, it panned out along expected lines. And I think that was also the consensus. China, on the other hand, was a mad bull market and has been a mad bear market as well. Again, China market going up 150% had no ripple effect on any other market. No market in the last 12 months has gone up 150%. So it's coming down 30% again has had no impact on the rest of the world because when you participate on the upside, you will participate on the downside. But when you sat out that upside, you will sit out the downside too. So both these events, while they might be very significant for their own economies, they haven't affected really the global sentiment towards equities. But what it has done is that there is talk that the Fed may not want to raise interest rates this year as a result of this turmoil, which again is helpful for equities.
You're absolutely right because less than 2% of China A shares are actually owned by foreigners. So
there's a quota.
There's a quota for that. So even though it's a massive wealth erosion of about $3 trillion, that's only restricted to the local Chinese.
Well, it's not insignificant in the sense that if you look at consumption from China and companies that were benefiting from consumption of China will be affected. I mean, that there is no doubt about. But to extrapolate that and say there's a global recession that can happen or a big slowdown, I mean, that probably is a bit excessive.
Last time when we saw such a massive wealth erosion, purely in terms of numbers and in trillions of dollars, was in 2008. And that time you went on record and you said that globally India cannot move in an isolated manner. Everything is connected. But this time, even though we are staring at a lot of global noise,
it's not global. I mean, that's exactly what I'm saying. It wasn't global. It was very, very isolated to two countries. And one was a very small economy. And the other is a large economy, but then very local centered collapse in the markets. But the US didn't collapse. So the entire, 2008 was completely different. It's not even remotely comparable to these two events that have happened in the last 1 month. Not at all.
But on the margin, do you think the strength in equities is here to stay? And when I say strength in equities, I just don't mean Indian equities. Global equities have done remarkably well. Nasdaq is sitting at 5,000. S&P is not far away from an all-time high. We are less than 10% from an all-time high. European markets also have done rather well this year.
Very well. Japan has been doing beautifully. Well, the fact of the matter is there's a very simple trade in equities. As long as you keep interest rates low, equities do well. Now, rest of the world has already gone to the zero interest rate situation many years back. In India, the expectation is that we will not go to zero, but we'll definitely come down from where we are. I mean, it's debatable whether that happens this year or next year, but the trajectory of rates has to come down. So India always runs ahead in anticipation. So I think the global environment for equities relative to any other asset class, if you take commodities, they have been killed. And incrementally, they were killed because of China. But even before this Chinese event happened, commodities had been falling last 12 months, 18 months, right? Ever since actually the dollar started to rally. So if you look at commodities, that's not a place you want to be. If you look at treasuries again, or fixed income, the yields are just so low that you'll be absolutely nuts to be buying fixed income in today's environment in most parts of the world. Real estate, in particular in India, has really, the bottom has fallen out. So, what else is left? And ultimately, in the pie chart of investment, out of these four major classes, money will keep moving from one to the other. The three being out of the equation, the fourth one left is equities. And therefore, in India, you've seen massive inflows into equities from domestic investors. So I think it's purely just a tactical shift and not difficult to understand.
And if I look at that pie chart for equities, within that pie chart also, emerging markets are in stress and India clearly seems to be in a pole position. The basic definition of BRIC now has got disintegrated.
Yeah, because and this keeps changing. 2 years back, people said that Indonesia...
India output Indonesia.
Put Indonesia in, and the same fools are now saying that entire BRICS should go and only India should remain, and this is all nonsense anyway. And I don't know why people listen to these people who write such rubbish reports. And that said, India will always benefit when there is global turmoil. I mean, that we have seen historically, by and large, unless it's a Six Sigma event like 2008. But otherwise, in the Asian crisis, India was quite resilient. In the 2001 meltdown, only the tech part of India suffered. The rest of the market actually did quite well. The industrials did very well. And now also, since this whole crisis in China and Greece have happened, I mean, India has been very resilient because Indian market is a well-balanced market. So, I mean, it's very commonsensical for money to move into India when turmoil happens elsewhere.
Now, the first half of this calendar year has been tough and volatile for Indian markets. Nifty or Sensex, they have done literally nothing, 2 up 3% here or there. Can the second half be much better and significantly better?
It appears so because for one major reason, which is that I do expect that the lagged effect of the government's attempt to revive the economy through spending its own money will begin to have some effect. I don't think it will be a huge effect, but markets don't require huge effect to make the turn. What you need to see is if it was even a small delta can change the trajectory of markets. And I do think second half numbers might be a tad better than what we saw in the first half.
So are we on course to make a new high very soon?
I think many stocks are already making highs. I mean, you're being weighed down by many other stocks on the Nifty side, but I have been very bullish on small caps and mid caps. I mean, that's been the segment I have been amazingly bullish on. And if you see that, I mean, they don't seem to be suffering any bear market at all. I mean, even in the falls that we've seen in India, usually the mid cap index has been flattish, while Bank X might be down 1% or Nifty might be down 1.5%. Small caps will typically just completely fall flat in such meltdowns, as if nothing matters. So that is telling you that there's a stealth bull market already on. Okay, it may not be very apparent if you look at Nifty, but it's definitely apparent when you go one inch below the Nifty.
So this market is not a mature bull market. This is still a young and a vibrant bull market.
I don't think it's mature as far as the small and mids are concerned. It's very mature in my view as far as large caps are concerned. And my view is that large caps are not going to give you more than 10-15% on an aggregate basis. Now that might be great for mutual funds, but that's not great for me. I mean, where fixed income is yielding you 8 to 10%, 15% doesn't excite me. But small caps and mid caps, you can make 100%. And I don't want to enter market looking to make 15%. I'm sorry. If I have to enter the market, I want to make 100%. I don't see that happening in any of the mainline stocks, but I definitely see that happening in the small and the mid.
So on a 3-year basis, you don't think any Nifty 50 stock could be up by 100%?
Up 100%?
In 3 years?
I really doubt it.
Even banks?
I really doubt it.
You've liked PSU banks in the past, you've disliked them, then you've liked them, and you've disliked them. Yeah. So what is the stance right now?
I don't like them right now.
Why is that?
I mean, in the sense that I think there is plenty of other places, even in the large caps, where you can make reasonable return with a little bit less risk. PSU banks, I think the NPA problem still exists. I don't think that's gone away, and I do believe that capital infusions being talked about are vastly underestimated. So there's going to be permanent pressure on the balance sheet for a while to come. So, I think there are far, far better places, even in the large caps, where you can, safely play and, make your garden variety 15%, if that's what excites you.
So what is on your list if somebody is looking at 15%, 17% returns?
It's the usual suspects, Nikunj. I mean, nothing extraordinary. It's the same old, ultimately you have 50 stocks, out of which 30 stocks are not worth talking about. It just comes back to the same old 20 stocks which have done very well. And, I'm sure the autos, which had, particularly the two-wheelers, which had a bit of a rough ride, I think that's, again, probably behind them. So I like two-wheelers, I like Bajaj Auto, and I like Hero Honda. So those, and Maruti, of course, has been a favorite for many years, continue to like it. But don't ask me to like, a Reliance or...
You've never liked it?
Yes, if you take a 25-year snapshot in the market, then I don't think I've liked it for more than a few months.
Even though GRMs have stabilized, Reliance Jio launches around the corner, you're not very impressed with the roadmap?
I just think there are far better ways to spend your money. It's an index stock, so for some people it's a mandatory weighting, whether at the market weight or lower. But, from my perspective, it is...
What is so special about Maruti at 25 times 1 year forward? It is expensive.
In India, nothing quality is cheap, unfortunately. Even in mid caps and small caps, any company with a with even basics of a brand in place are all 40, 50, 60 times earnings. And La Opala Glassware, which is a very good company in my view, is what, 50, 60 times earnings. I mean, so...
But they're growing.
That they're growing. So is Maruti. So India is not going to be cheap for branded companies, 100%.
There's a very big contrarian side to Shankar Sharma. And you always like to do things differently, especially you don't like to go with the crowd. The crowd currently is bearish on Tata Motors. You've liked Tata Motors in the past. Tata Motors, as we speak, is now sitting at a 52-week low. Yeah. Is the China fear slightly overdone?
I think it's slightly overdone, but that doesn't mean that I'm a, outright table-thumping bull on Tata Motors. I mean, we moved away from Tata Motors a couple of years back.
That was a great trade.
And I think I told you that too. That there's a time and a place for every stock, and I'm not a believer in holding stocks forever. So there was a time and a place to buy Tata Motors, which we did, and there's a time and a place to get out of it, which we did. And I don't think it is compelling enough right now to go out and buy. But I think China luxury end of the market will be still quite okay. What's been really hurt are the people who are really middle income, and I don't think Tata Motors crowd is the middle income crowd. So I think fundamentally I don't think it is a doomsday situation for that, but I'm not excited enough for it to to say that it's a buy as far as my thinking.
IT has always been the safe sector, but that safe sector is now struggling. There are chinks in the armor. Small IT companies are struggling because they cannot ramp up. Large cap IT companies are suffering because market share is not growing, and others are suffering because they cannot move up the value chain purely in terms of digital platform. Can I safely assume that the golden period for large cap IT stocks or large cap IT companies is over?
I don't think one should be so pessimistic, but I think for sure that Indian IT has to reinvent itself. I think they have done same old for many years. And I think the rise of this huge startup ecosystem is going to pressure them even more when good quality people will not want to work for a old line company. I mean, they are like an old economy, new economy company, right? So they need to really reinvent themselves. I think their managements are terrific. I think Vishal Sikka is doing a lot of good things. I think it's a good, exciting talent. But to expect 2 quarters out something dramatic will happen is not going to happen. But I think, they're still a good 2-3 year horizon bet. I think Mr. Chandrasekharan is very cognizant of the fact that there are problems, and I think they're working towards it. But remember, they're big 800-pound gorillas or big super tankers. They'll take time to shift. But I don't think they are done and dusted. I don't think that's the assessment one should have.
So one should not go down the pecking order. Stick to quality, stick to large cap IT, because those are the guys who've got talent and skill and scale.
Definitely. So I mean, unless you see a lot of tech listings come up in India, which I suspect will happen, till then the small Indian IT companies are doing pretty much the same thing what the large IT Indian companies are doing. I mean, there is really no difference in the business model, and which is why they're struggling. But if they were doing something very innovative, then I'd be happy to take a look at them. But I don't think I'd find anything in the second or third tier ITs which is telling them that they have a joker in the pack that they can draw and unseat the large companies.
Yeah, everyone is claiming that we are going up the value chain, we are doing digital, we are doing
but that we have been hearing for...
And numbers are not there, let's be real. Numbers are just not there. Now, TCS is more like a comfort trade. They're growing at a run rate which is higher than the industry average. Infosys, I feel, is a hope trade. So would you go for comfort or hope?
Why not both?
You're excited about owning both? But they both are different models.
I'm not excited about owning any large cap. As I said, that 15% doesn't excite me. I see 100%ers out there. Why should I waste my time and money looking at 15%? That's great for funds and I have no problem with that, but that's not for me.
Last time when I interacted with you, you said that, look, I'm ready to buy the dirty picture, which is companies which have a huge debt. Let's not write off infrastructure sector. What's the logic behind this?
Well, I find there are some interesting plays in there. You have to really clear the rubble to find them.
Drop a hint.
No hints. Cannot.
But where are you hunting? Because you like to fish in the $1 billion or the $2 billion pond, even below that. So you're really hunting in companies which have a market capitalization which is sub $1 billion.
Yeah, definitely.
That's really the gold mine one should focus on.
In my view, yes.
What about the risk?
Of course there's risk, but that's what I get paid to do. I mean, that's where I'm going to make 100%. I'm not going to make 100% buying a Larsen & Toubro.
So let's extend that logic. That why do you think one should not one should buy into companies which have a huge debt? Because for the longest time, markets have punished and they've really thrashed companies where debt has been a concern.
Yeah, and I've been part of the gang punishing them. I mean, of course.
The first one to blow the whistle for the infrastructure
Absolutely.
sector, I think 2009.
2007 actually
2007,
held the peak of the market.
yes.
But that was then. You know, and like I said, I mean, there are no permanent friends or enemies in the markets, just like in politics. So I find there is value in some of the smaller ones. Definitely. I'm not going to name them, but if you look hard enough, you'll find a few in the range of, a couple of 100 crore market cap.
So what is the criteria for selection?
There's no criteria. I mean, first of all, there has to be debt.
Okay.
Which inevitably there will be.
Yes.
And then I have to figure out, is there a spark of hope in their collapsed structure that can revive them and therefore make them come back and pay back the debt, or at least reduce the debt. You don't need to become debt free. If you have 100 rupees of debt, if you come down to 70 rupees of debt, that from a stock market perspective is a huge delta on the stock price. So for these companies, the mantra that I have is that things have to only go from being very awful to being moderately awful. If I see it becoming moderately awful, I'm a buyer, because that's where I'll make 5x. Okay, when they become normal, then it's a normal return stock. So you have to go fishing a little bit into the deep end of the pool, not in the shallow end of the pool.
Yeah, a little bit of hope, and then you have to do your homework, of course.
No, you didn't do a lot of homework. You have to think big. You have to think of the big picture. Can this company survive? Once all that is done, then the trick is there has to be some spark of hope in the business models. And that said, I do believe also on a macro basis that infrastructure looks like a good space, because the government has understood that, look, to expect private sector to or banks to foot the bill is not going to happen. They have to kickstart it, even if it means risking the national balance sheet. Okay, that may have its problems, but that's a few years down the road. So I think the government is doing the spending and continue to do the spending, which is good for the sector.
So the criticism which a lot of foreign brokerages are throwing at the government, that the rate of change is slow, economic acceleration is poor, that's all humbug?
No, it's not humbug at all. Not at all. That is very real. But the fact is that, and again, I come back to my central theme, why I like small caps and medium small caps. I don't think the changes the government is making are that big so as to influence the trajectory of a Larsen & Toubro or a BHEL. Okay? But I think those changes are enough to give a significant boost to some of the smaller companies.
So fortunes for NCC may change, but fortunes for L&T may not change.
Exactly. If you're a 500 crore top line company, if you get a 100 crore order, suddenly you're looking very different. If you get a 500 crore order, you're home and dry. Even if Larsen & Toubro gets a 2,000 crore order, it doesn't even show up. It's not enough to move the needle. So hence, I am cognizant of the fact that the government will spend, but will that spending be enough to move the needle for the large ones? I'm not so sure. Will even a small part of that trickling to the smaller ones, will that be enough? I think yes.
So if government is committed to increase spending stroke expenditure, a big beneficiary could be cement. Now cement is not a global commodity, so globally commodities are coming down, but cement in a sense has a natural moat. Sure. It has immunity. Sure. Is it a good time to buy into cement stocks?
I think there's so time to buy cement stocks. Because remember, there are very few small cement companies. There are still very large cement companies. It's a fairly consolidated industry.
One or two regional players, that's about
exactly. So in that sense, again, like I said, the same problem that besets Larsen & Toubro will be that for the cement companies. So look for the smaller ones. That's the thing, that in an economy where there is some growth coming, I only have to see that small part of the growth going to a small company can make their company go up 5 or 10 times. That's what I'm focused on.
So if risk comes back, and if infra picks up, and if economy picks up, will quality underperform? And when I say absolute blue chip, an HUL, an ITC, an Nestle, will they underperform now?
Inevitably they do. These are all risk-off trades. When risk appetite comes back, then usually the beaten down, the junk end, highly indebted companies do well. I don't think that time is here now. But where the market is clearly telling you is that looking at good quality mid and small cap companies. I mean, just the sector performances are telling you that. So I think the market has discerned it very well, and I'm following that. I'm not being contrarian there. I think market is propelling us to believe mid and small is a good space, and I buy that argument.
In 2007, when the world was gung-ho and gaga on telecom, a report hit my mailbox. from First Global. It says time to sell telecom stocks. Now I look at telecom stocks, they've done nothing. But now progressively, can things change for the telecom sector? The raw material, which is the most important ingredient for any company, is in place. And for a telecom company, the raw material is spectrum.
I don't think so. I mean, I think in any case, the entry of Reliance Jio
Be disruptive.
Is a big overhang on the sector. So while yes, if Reliance Jio had not been around, the thesis would have been positive. But with them around, and the only game Reliance knows is, a cut rate.
So you're bullish on the launch of Reliance Jio, but you're not bullish on Reliance as a stock.
I'm not bullish on the launch of Reliance Jio for anybody. Please understand. I'm bullish that in the sense that it will give a lot of options to content companies and stuff like that. But I don't think it's great for Reliance, or I don't think it's great for Telecom either.
What about the data opportunity?
Yeah, I mean, this is a nice story everybody has spun. Again, I don't think that will be significant enough for the telecom company. And looking at what the pricing I'm being told on the Reliance Jio part is that it will be so cut rate that it will hit the ARPUs of...
Is it a good time to buy into commodity producers, paint companies, tire companies? The natural trajectory for commodities is certainly south, it's not north. The saving on debt, the saving on working capital, EBITDA expansion, they could be significant.
Again, they are large companies.
Okay.
So find me a small paints company, I'll be very happy to buy it. Asian Paints, again, to move the needle, I need to see a huge resurgence in the domestic consumption, particularly rural consumption, and that's still hurting. So I'm making a very clear distinction. Large companies are not going to see large growth opportunities, but moderate growth opportunities for a small company is a large growth opportunity. If you can understand that.
Of course. So let's say a year from now, if we are interacting on the same forum, what kind of global environment do you think we could be staring at?
Well, a year out is too much to speculate
6 months. Let's talk about Christmas. Till Christmas.
I think you're staying put. I don't think any major crisis appears to be. I mean, the only imponderable is the US rate situation. But again, that is probably pushed out into 2016 now because of the Greece crisis and the Chinese crisis. I don't think the Fed will raise rates in this kind of environment. And I don't think in any case the US deserves a rate hike. Economy is still not as robust.
Data is not bad. Unemployment rate has come down.
That's because many people have dropped out of the race. That's a little bit of a tricky number, so you need to analyze it a little bit more. And the other thing is that most of the jobs that account for this 5.6%, or whatever the number is, are low-paying jobs. So there's the waiters and the bartenders and all that. It's not like really skilled workers. So just this one point, I don't think is good enough for them to become bullish.
Every bull market has a theme. Every bull market has a new horse. Like they say on Wall Street that courses remain the same, horses change. What is the horse of this bull market?
Small caps.
Well, that's not a horse. That's more like a clan. Let's talk about something specific, because every bull market will create a new sector.
I'm saying there's no bull market. I mean, it's a bull market if you talk 15% a year, or 12% a year. If that's the definition of bull market, we are already having one. But then, all your banks are going to deliver 10-15% kind of numbers.
So I won't get into small cap stocks with you, but is it a good time for some of our viewers who are watching the show and they want to benefit from your wisdom, maybe start a SIP in a mid cap or a small cap fund?
100%. It's a no-brainer. It's an absolute no-brainer.
In the past, you've advocated our viewers that, look, it's not important to invest in India, but it is important to invest correctly. So for someone who has a 3-year time horizon, how should they invest?
Well, you can go and buy mid-cap funds or mutual funds. I think they are very, very good vehicles for you to get in without bothering your head about which promoter is a good guy and which guy is a thief. And I think they are very good, very, very good choices. So I would wholeheartedly advocate buying mid-cap funds.
And just to wrap today's interaction, and I may sound slightly repetitive with this one, your view is that what is happening in Greece is small, what is happening in China, don't bother, let's focus on US and US.
No, bother, but it's localized. It's localized.
And it will not have a contagion effect.
No, I don't think
so. What could be the trigger for India? I just get a sense that suddenly the bulls have an edge. Monsoon not bad, Fed is unlikely to move, and then commodity prices have come down. Do you get a sense that bulls suddenly have an edge? All the concerns are getting addressed one by one?
100%. Bulls have an edge. No doubt about it.
So this is a bull market. Stay invested. Market volatility, well, don't worry. Just stay invested.
100%.
Shankar, appreciate your time. So glad you could join us.
Sure.
Thank you so much.
Bye.
Thank you.
Find Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.